how does cash flow and financials and all that equate to fun. But we're going to have a little bit of enjoyment here. We're going to talk through a lot of things. Just so you know, my goal today is to get you thinking about being proactive rather than reactive when it comes to your financing. So we'll be talking about a lot about cash flow planning. So first of all, we're going to make sure everybody understands why cash is king. Number two, we're going to talk about the difference between profit and cash flow. Then we're going to kind of do a quick run through of a cash flow forecast to kind of get you understanding the thought processes that are involved there. We'll then jump into how to improve your cash flow, and then we're going to do a very, very quick covering of accounts receivable management. Now, I do want to say there is like a 38-page manual that kind of goes over all these things in more detail than we possibly could cover in 1 hour. So today, as we go through this, I definitely want your questions. So please take a moment, make sure you see the chat box, pull it up. Please, as you have a question, post it on here, and as I get to appropriate stopping points, we'll kind of double back and discuss those things. Again, I want this to be very, very inactive. Please don't put this on mute. Sit back and not participate, because that's how we make sure we all learn on this. So let's kind of jump in today and get started. One of my favorite things is 80% of all businesses fail. And when you look at the statistics, it's all this thing called capitalization. And in a nutshell, all that means is that they're running out of cash. And what we'll talk about today is that each of us, our businesses are inherently built with something called a cash gap. And that cash gap either helps you end up being successful in the long run when you learn how to finance it and use it to your benefit. But if you don't, you definitely will feel pressure. That's whether you're in survival stage or you're in takeoff stage. Both of those stages really are impacted by this more than anything. So again, cash is king. We're going to talk about it all day. It's not profit, because profit is a theory, and I love going over this one in class. Bottom line, when you look at a profit and loss statement, it's basically saying these are the transactions that occurred in this period. This is the expenses and the cost of goods sold, and you get this profit. The problem is that profit number is impacted in so many different ways. You know, it's as simple as depreciation and bad debt that actually it shows a reduction to your profit, but those are non-cash expenses. But here's the key ones that affect you. Profit is necessary to make loan payments. Now, your expenses, your interest is definitely expense, but your actual principal payments have to come out of your profit. So when you think about it, you may earn a $10,000 profit in a month, but if you have $4,000 of principal payments against loans, bottom line, your cash flow isn't that $10,000. Your cash flow would only be that $4,000 or even less. The other, which many of you have seen in the class this year, is the accounts receivable. Again, profit is great, but if you don't collect the sales, you aren't driving cash flow. And again, if your AR keeps increasing over time, you're not going to have that cash to be able to use for other expenses. Other things such as down payments on capital equipment. You may be able to depreciate it over time, but quite often if your down payment or the actual purchase is made with cash of new equipment for your business and you're not able to fully depreciate it that year, again, that uses the cash you have. And then two, the surprises are those distributions to yourself. If it's not salary, that end of year distribution, basically takes cash from you. And even more, though, is when you put a reserve in place for next year's taxes, a rainy day fund. That cash has to come out of your profits. So while profits may look good like the ABC company did in the class, reality was that ABC company actually had a negative cash flow. And when you looked at that statement of cash flow summary, you basically saw that operating cash flow, that OCF, that basically is your livelihood. Is my operations, or are my operations actually generating cash? So be aware when we talk today, we're going to avoid sometimes the theory and really focus on what cash are you seeing. So I'm going to take a stop right now. I just went through a whole bunch of stuff really quickly. Is there any questions so far that anybody would like to post? All right, I'm going to go ahead and jump up. Um, Number two, we're going to kind of just really clarify this. A few of you who have professional services, you may be using something that is called cash basis accounting. This typically are doctors, architects, anybody who does a small company that is in professional services. The vast majority of you will be using accrual base. That's basically when we try to match the income and the expenses in the month they happen, not when you get paid, but actually when they transpired. So again, all of our examples today will be using accrual based. If you're cash based, actually your reports will keep you a little more simple than what we're going to go over today. So what is this cash gap I keep talking about? And when I try to say it, it's if you were to open a business today, you would need to bring in inventory. You would need to hire people, even though you don't have any sales. And from that day one, that clock's ticking when you have to pay for that inventory, or you have to cut paychecks to your team, even though you've not made the cash from the customers. And when you throw in a company that has receivables, this cash gap can even extend to 60 to 90 days. The example up here shows bottom line on day 0, this company landed this inventory. And this inventory was there 60 days before it sold. And that inventory was shipped on day 60, and its terms were net 30, but the company that bought it did not pay for it until 60 days after it was shipped. So basically what you're seeing is we did not get cash until day 120. So in the middle here, that person had to pay wages, had to pay rent, utilities, and had to pay for the inventory after 30 days. So that basically shows where they had a cash gap. In other words, where they had to basically be out the money for 90 days before they actually got the cash and made the profit on the sale. And this does vary by industry. If you are a services type company that basically you do the service today and you get paid today, you truly aren't going to have that cash gap. But if you're having to stock a truck with materials and only use those as needed, there's going to be a cash gap at times from the point you buy those materials till you actually use them on a job and basically have them. This actually even gets more complicated as you get into a retail where maybe a store is buying that inventory and landing it in September, having to pay for it until in October, and they're not going to sell it till November, December. I actually throw a little bit of trivia with you. Black Friday was the day that most retailers actually were able to pay off all the goods they purchased for Christmas and start making a profit. That's actually how the Black Friday got named. So if you think about it, from the point of view from early October when they had to pay for those goods till end of November, they basically had a cash gap. And then it even gets more exacerbated in a manufacturing type situation where you're having to buy materials and labor, and you make the finished goods. You're sitting with those finished goods in inventory for 30 to 60 days. They get shipped, sold, and you're still waiting 30 to 60 days to get payment. That can be up to a 90 to 120 day cash gap. All right, so what questions do you have on cash gaps or comments? Do you see this in your industry? Kind of pop up a little note on your chat if you would, if this makes sense, or if you've got a question about this. Thank you, William. Thank you, John. All right, well, if you have a question, don't wait for me to ask. Feel free to go ahead and pop on here and let me glance at it, and then we'll go from there. All right, the next thing I'm going to jump on is kind of going back to your profit and loss, just to make sure we're kind of all on the same wavelength about what counts as what. And basically your profit and loss basically has five different areas: sales, cost of goods sold, which are truly your variable expenses, your gross profit, your fixed expenses, and then your net profit. And most of us know this, but where I want to take this is that cost of goods sold or cost of sales. These are truly your variable expenses, and these are totally dependent on the sales you are getting. And when I say this, if you would not have any of these expenses if you had no sales. So you will see a direct relationship between growth in sales as well as growth of these expenses. Things that fall into this category are direct labor, materials. For franchisees, I put franchise fee on here, sales commissions, services purchased. If you're in a construction industry and you're needing to use subcontractors, they should be in this cost of sales, as well as purchases of supplies and material. The reason why I encourage them here is it truly gives you a gross margin, which is your gross profit divided by sales, so that you can start projecting what will happen to your cost of goods sold as your sales increase. Your fixed expenses, on the other hand, are sometimes called overhead. These expenses occur no matter what your sales are, and they don't significantly change from month to month. A lot of times people talk about, well, my utilities can vary. Again, they vary a little bit, but they don't vary based on sales. They vary based on the weather. So again, when we're looking at these, the cost of sales and the fixed expenses, I'm really going to challenge you to be thinking about and getting those cleared on your financial statements to make sure you feel good about them. In this case, we're going to talk Widgets R Us very quickly. Bottom line, Widgets R Us makes 4 color widgets, 122,000 in revenue. Their direct labor and materials basically were, there's an error right there. Well, no, it's right. 63,000 that left a gross profit of 59,000. So when you take that 122, subtract the 40 and the 23, you come up with that 59. When you think about that and divide that 59 into 122, you basically get a gross profit of 48.4%. Everybody with me on this? 59 divided by that 59,000 divided by that 122,000 is going to be a 48.4%. On the reverse side, we know that those two expenses, direct labor is going to run slightly over 30%, And it looks like materials are running just under 20% when you divide the direct labor and the materials into those sales. So those are going to be the key variable expenses for this company. When we take this a little further, the fixed expenses for this company are going to be $41,000. Bottom line, as you look through this list, these are things that are not probably going to change from month to month. Again, a lot of times people go, well, my sales and marketing vary. Again, they do vary, but typically that's because a bill was due 1 month and it could be for 2 months of use. Again, these though are fixed expenses. They're going to vary a little bit, but for the most part, they're going to average that $41,000 each month. Now, the wages and salary here are truly meant to be administrative or ownership salaries, which are based on the sales. Not based on the sales of the company, but they're going to be there whether the company has huge sales or even average sales. Now, somebody did ask me a quick question. I want to go back to this. The gross profit margin for this company that we looked at is 59,000 divided by 122. The gross profit is 48.4%. All right, so when we look at this, we're going to start thinking when we're planning, all right, if the Widget R Us Company does 150,000, we still know that we're going to have about 52.6% variable expenses, and we will be providing a 48.4% gross profit that month to pay our fixed expenses. As you can see, when you're using the rate, as the sales change, you'll be able to vary and understand what your direct costs are going to be for that month. The fixed expenses should stay the same each month. Now, just one other clarification before we jump into this a little deeper. Just want to make sure everybody's with me. Assets are what we own, liabilities are what you owe, and equity is the outcome. Equity is the value of your company after you subtract what you owe. Be aware, to reduce a liability, that is coming out of your profits. That is not an expense. So when we reduce those things, just like assets, when you raise an asset, it basically has to come out of cash in order for you to fund it. Or in the case of inventory, if you sell down your inventory, it's going to free up cash for you. So when we jump into the next one, your cash cycle. In fact, I'm going to pause real quickly. Any questions so far on what I've covered? And as you can kind of see, I'm kind of getting you set up for jumping into some stuff that's going to kind of get into showing your flow. Any questions on any of the things I've showed you so far, please just type in "good," "I'm fine," or if you have a question, just pop it out there real quick. All right, good. I appreciate y'all's feedback. So now we're going to kind of jump into the cash cycle in trying to understand it. Basically, kind of when you think about what I was just talking about, the assets, bottom line, most businesses are going to have 3 key assets that come into play here: inventory, receivable, and accounts payable. And when we talk through this, accounts payable, I'm also talking in this paying our bank for a line of credit or other debts we may have. Bottom line, when you look at the purchases, that's where this cycle all begins. You make purchases, you build up an inventory. That inventory sells, which creates accounts receivable. And as you collect your accounts receivable, that frees up your cash to pay off your accounts payable. So as a business, you're kind of saying, what are the key things that can do to help me get cash, or what things will use cash? So as we're building a cash flow model, you're basically saying, when am I going to have free cash to build my inventories? How do I aggressively keep my receivables under control? And when it's appropriate, when do I delay paying my accounts payable? So what we do here is take this cycle and then start matching it to some of the metrics you've learned in emerging leaders. And I'm going to go over 3 different ratios that you've probably learned. You saw them in the book Managing by the Number, or your instructors probably shared with you, or you may even know these. The first one that I love is accounts receivable days. And again, while I don't have a balance sheet to show you, it's basically the amount of your receivables divided by your sales times the days in the reporting period. So again, your accounts receivable are going to come from your balance sheet. Your sales will come from your income statement. And then you'll say, is this a monthly report or is this an annual report for the last year? If it's a monthly report, you take that receivables divided by sales times 30 days. If it's for a year, you'd use 360 or 365. It's so funny, you see different accounting books use both of those ratios. I'm from the old school, you average every month at 30 days, so 360. But in this case, this example, this company had 240 days of receivable, or 240,000 in receivables. It does $1 million a year. You multiply that times the 360 days, their receivables would be 86.4. So I want to take a little poll here. Is that good or bad for your industry? Who would say that's good and who would say that's bad? I think most everybody's coming saying it's bad for their industries. Most of us do deal with a net 30. So if you were to see this, you'd basically go, wait a second, I should be getting my money after 30, maybe 35 days at the longest. This company in particular is basically looking at 50 days of extra receivables at the least. And if you think about that 50 days, that's about, what is that? Probably about 160 they have too much in receivables. So again, as we talk through this example, you're going to see this company definitely could free up some cash by improving its receivables. Number 2, it's called inventory days. This is for those of you who carry large quantities of inventory. Very simple, similar to the accounts receivable days. You basically take your inventory from your balance sheet, divide it from your cost of goods sold, okay, from your cost of goods sold on your income statement times the days in the reporting period. And in this case, you're looking at, hey, they had $200,000 of inventory. The cost of goods were $700,000 of what they actually used during the year. So bottom line, times the 360 days, they have 102 days of inventory. And people will, while most everybody has an opinion about receivable days, this is one where you really want to go on the internet and be able to pull up what your industry standard is. If you were a convenience store, this would be a very, very high number. Yet, if you were an automotive or industrial supply store, this might actually be a little less than what the industry average is. I typically recommend you if you do carry inventory, learn what your industry is, but also see what you can do to measure this, track this, and try to keep this down. Now, you don't want to be out of stock, but on the other hand, you don't want to be carrying a lot of inventory that was dead. The last of the three is how quickly do you pay your bills? And again, in this case, this company had $100,000 of payable. They made 700,000 of purchases last year. Remember, cost of goods sold times the 360 days. I'm going to be saying they're paying their bills on average 51 days. Now, the advantage to this is if their vendors aren't complaining or this is normal in the industry, it may not be bad to take advantage of it. And this could be part of the reason why their receivable days are so high, that this is not an industry that really puts pressure on paying these things. But in this case, he's using other people's money instead of paying his bills. Most of us want to keep this about 30 days. Most of the businesses we buy from, they expect their payment within 30 days net. So again, what you're seeing in this example of a company, they're not collecting their receivables. Their inventory, we don't know if it's good or bad, but in terms of it, their days payable is pretty high, so they are using a lot of people's cash. So kind of now let's kind of look and say, okay, so what does this company need to do to add cash? They need to be driving those days of inventory down. Now, we don't know how much they should, but this would definitely, if this company's cash starved, be needing to look, how do I manage my days of inventory down? Number two, how do they quickly, in this case, drive their receivable days down? Again, if they're an industry that's typically net 30, they had a lot of money hanging out there. And then lastly, if they're in trouble with cash, they may need to go ahead and hold off paying their bills a little bit more. Just the reverse, if cash is not a priority, they may invest in more inventory if they believe they're going to get that return. Now, the next one I don't think I've ever recommended is to allow your receivables days to go up. To me, that's just a waste of dollars. And then finally, if you've got the cash, go ahead and get current with your vendors. Get within the 30 days. Again, I don't think you want to pay immediately. Take advantage of their terms without abusing their terms. But bottom line, if you look at this cycle, if you're managing these three black things, inventory, receivables, and payables, you will be able to maximize your cash in your business. Any questions before we start doing a forecast? Does this make sense, or is there any questions that you have? All right, I appreciate it. And guys, I apologize. We've got a lot of stuff kind of getting through. All right, now we're going to kind of jump into doing a cash forecast. And again, this is keeping in mind those things that we've been talking about. This is kind of how your spending habits are in terms of how much you do buy for things, the cash that you have, your loan payments, as well as the cash that you have coming in and coming out. Kind of just to be clear with everybody, you basically have four ways to have cash in your business. It's number one, your operating cash flow. It's income generated and collected. Number two, it's borrowing cash from banks or other people. Number three, it's the sale of assets. Or number four, getting cash brought into your company from an investor. Again, most of us want to focus on number one, how can we get sales and income generated from our business? The five main uses of cash, and each of these will have an area on your cash flow forecast. Your fixed general expenses, the purchase of a fixed asset if you need to do that, loan repayments, owner's draws, and then something that is often overlooked, but I strongly recommended is a reserve for emergencies. And again, that reserve is cash put aside in case you need it. I don't know how many of you, without taking a quick poll, but quite often I find if I ask 10 business owners if they've ever struggled to make a payroll at least once, 8 to 9 of them will raise their hand. All right. How to do a cash flow forecast. And again, I do want to remind everybody you will have a kind of an instructor's guide to doing this that you'll be able to look at that will be printed. Bottom line, what we have to do is start making educated, but these are truly guesses and estimates of what you're going to have coming in. Now, the thing about it is going out is actually easier because you already have figured out what your cost of goods sold percent should be and what your gross margin that your company should earn. And again, as you look at this on a monthly basis, you'll be able to move your cash out amounts from month to month. And I laugh about this because someone goes, well, if the bill's due, a lot of times you can nudge it a week or two if you call the debtor or the person you owe the debt and say, hey, I'm tight this month. I'm going to move this a couple. It'll be there by the 15th of next month. So again, we're going to show you how when you've got that bad month, how to move things around, because what we want to do is have a positive or a zero cash flow for every month of the year. Finally, you want to balance with your bank statement. Again, one of the biggest mistakes I see with people on cash flow, they're using their daily bank statement balance instead of reconciling it so that they have an accurate amount of cash in their system. And when I say that is, bottom line, reconciling includes saying, what do I have outstanding, both as deposits as well as checks, not just what I'm showing in the bank today. So to start with the sales projection, what I usually do is recommend that you get 2 to 3 years of history. And you basically say, all right, my business was $1 million last year. I'm projecting it's $1.2 million this year. I look over the last 2 to 3 years by month, and I basically see the strengths, what months are bigger, what months are less. I like to use a 3-year average so that I can really see what each month will look like. And there's an Excel spreadsheet that will be available after this that basically you'll fill in your prior 3-year sales, then set a goal for 2017, and it will allocate by month based on the average of that month to your total. So you'll have a good idea based on history what each month should do for sales. Now, it all starts with your annual goal, and you've got to have the plan to get to that annual goal. But if you put a reasonable goal in there, it should be able to give you monthly benchmarks that are fair that you can achieve. Now, I do have some other companies in the construction world. They basically, instead of doing an annual cash flow projection, they work it on a 90-day to 120-day forecast based on what jobs they've got in their funnel. I like to basically use the annual approach even for them, just because year to year there could be so many variations. The other thing is we see jobs getting delayed quite often, and that can throw the forecast into a jumble and cause a crisis. Not only do you need to say when my sales are going to happen, but number two, when are we going to receive these this cash in? Usually it is 30 days after you've made those sales. Again, the example we used in that company, Widgets R Us, they're basically running 100 or 86 days. Again, that's not acceptable. I would challenge you all to look at a 30 to 40 day receipt time. So basically, what you sold this month, you will receive next month. So again, as we do the cash flow forecast, you will start saying, hey, this is when it will happen. Next, it's understanding what you pay bill wise. And this is basically saying if it's a variable expense, we're usually going to use a ratio for the variable expenses, those cost of goods sold, where the fixed expenses are going to be more of a raw number. And what I mean by a raw number is we're going to say your expenses on average for the year is $12,000, therefore we're going to pay about $1,000 a month in utility bills, or your rent is the same each month. Now, when we get into some of these expenses, there are some ones that do throw people for a loop. Number one, taxes, especially property taxes. Most people pay them all in 1 month. It's not something you allocate over the year, so you need to make sure taxes, whether they're quarterly taxes or annual taxes, are budgeted correct. Number two is insurance. I find a lot of people have quarterly payments, or they pay 10 months and have 2 months without it. And then the third thing is if you have a weekly payroll, there are some months that have 5 payroll periods, not 4. This year, March, June, October, and December are, excuse me, September and December are all 5 pay periods. So you need to take that into consideration as you go through these expenses and add that additional payroll in. And then lastly, you do need to account for, after the profit, what are the payments of debt? What reserves do you have put in place? And then if you're going to pay any kind of a bonuses, a lot of times, even though that will go under salary on your final expenses, a lot of times planning for those bonuses as if it was a debt payment will at least let you forecast those cashes. So we're going to start with this company, and this is their budget. And again, this is not a cash flow budget. This is just basically saying we see this is the way their sales are going to fall out by month. Their cost of goods sold is running about 75% of sales, so their gross profit is about 25. And again, they're estimating based at looking historically what were the cost of goods as a percent to their total expenses. So bottom line, as their sales go up and down, they should know about what will be the profit they will create each month. They have their fixed expenses. Their fixed expenses basically are $15,000 a month, except you see in March where they've got an extra payroll. In this example, what we were looking at, this is somebody who pays every 2 weeks. And bottom line, they said, woo, March is where I've got 3 bi-weekly paychecks. The owner's salary is the $5,000 a month that's coming out. So bottom line, you can see their profit by month. Over the 6-month period, they basically break even. So before I go any further, does this look like a fair budget for a small business? Or is there any questions that you have so far in what I've kind of gone over? Because now I'm going to we'll start tweaking it in a minute. All right. Thank you, guys. All right, so I'm going to jump in. First thing I want to do, though, is to kind of add in what was the month of December before this budget started. And again, the month of December was a little slow. Their business kind of quieted down during the holidays. Again, they ran their 75% cost of goods, so they had a gross profit of $12,500. Fixed expenses were $15,000 for the month. Owner salary, $5,000. Excuse me there, guys. So they had a net profit of negative $7,500 to end the year. So bottom line, though, even with that tough December, they ended up the month with $5,000 in the bank. Everybody with me on what this looked like? So now what we do is we're basically saying, so how does this impact their cash? The reason why we're looking at this and it looks different is, bottom line, the receivables, when they receive it, will actually be in January. And they will pay their suppliers in January from December. So they will get gross cash received of $12,500. If you remember, that was actually their gross margin in the month of December, but because they pay their suppliers and they receive their money 30 days after, they're basically going to have $12,500. Now, they're still going to have the same fixed expenses as their budget because that's consistent. The owner's going to still pay themselves, but the challenge here is they're going to have a cash loss of $7,500 in the month of January. They're going to have to pay a loan payment. So bottom line here, they started with $5,000. They spent $7,500 and another $1,000. This company, if it does not do something, is going to have a negative cash flow in January. And if you look ahead, you're kind of going, well, they should be fine by the end of February. So in this case, this owner may be able to say, how do I delay paying my suppliers $4,000 to $5,000 to be able to cash flow this? Again, what happened in December is actually what you're paying for in this case if you collect in 30 days and you pay your bills after 30 days. If you look at this, this company is fine until all of a sudden we hit March, and in which case, instead of paying down their debt, they're going to have to actually take a loan to be able to get out of the doghouse at that point. In April, May, they're still taking some more loans, but they're actually delaying payment so they can get to June where they can go ahead and start paying things and get ahead and pay down their debt $2,000. Bottom line, what you're doing is you're taking your profit and loss budget and saying, when is this money going to be coming in? How is it going to flow? And being proactive in this case to know, hey, bookkeeper, I need you to hold back this $4,000 invoice and pay it in February for me so we can cash flow through this. It's understanding, having a line of credit that when we hit March, if we don't do something, we're not going to have enough cash to get through. All right, we've gone through these three things real quickly. Does everybody see the transition from the profit and loss statement to a cash flow budget? All right, I appreciate it all. Guys, when I talk to people about this, it truly is, once you've got your budget down, being able to then adjust it on the lines to the appropriate month makes it so much easier to see when you're going to be able to save money. This was actually a cash strap business. If you looked at it, their profit for the whole 6-month period was zero. The hidden problem was they were basically bringing a horrible month, December, into a flat 6-month period, and it came back to bite them. And when you have tough cash flow, you truly need to be thinking about, what am I going to have to do in the next 30, 60, or 90 days to be able to reserve cash or build on my cash? And again, remember, there's other ways, this could have been where in January they need to be able to drive their sales above their plan. It could have been an inventory reduction sale to free up some inventory dollars. It could have been too where this person got an aggressive receivable strategy and really challenged their team to go ahead and build their, or collect on all the receivables outstanding. All right. I do want to say the attached guide takes this through in much more detail. The Excel spreadsheet that will be available for you lets you plan on it and work with it a little bit. I also will welcome if you've got any questions as you start playing with this. If you want me to look at it, I'll be more than glad to look at your budget and how you set it up, give you feedback or maybe some suggestions to make it more workable for each of you. Just so you know, the example that came out on the Excel is one where they will collect the money that they sell in the month, and basically what you would do to adjust it is basically, if you're a 30-30, you'd have the same thing as here. You just would go ahead and look, your January cash flow is going to be what happens in February. All right, so I'm going to give you some bullets really quickly about how to drive your cash flow. And a lot of these are very similar to where things that you've basically seen in other books and other materials. A lot of this is being thoughtful about how each thing you do is going to go ahead and impact. First one is ask for mobilizations on contracts, or 50% down up front if it is going to be a company that has extended pay times or you've had bad experiences up front. Number two, it sounds so simple, but get the projects done. It is amazing how many times a project will linger 2, 3, 4 weeks just doing the final loose ends before a company will bill or invoice that project. Again, get those projects done, get them invoiced. Don't wait to the end of the month. Bill weekly, if not daily. And again, that jumps right into the next two. Systemize your invoice and collection process. Again, what this is basically saying is have a process that after so many days, you're going to be sending a collection note. After 60 days, somebody's going to be calling them. After 90 days, you're having a collection company get involved. But systemize each of your billing, your invoice, and collection processes. Have a one of the things I also have seen on this same one is, how do you give your bookkeeper all the things they need to make sure that they can finish the invoice and get it sent out? You need to put a checklist in place that everything has been submitted to them so that they have what they need to bill this. Again, I mentioned this earlier, invoice immediately on completion of the job. This is one that I've actually seen some companies have some great success. Give 7-day terms instead of 30 days or longer. Again, when you're negotiating a new contract, ask for 7 days, 15. Something that's been really interesting lately, a number of people in Memphis have been doing that with the county and the city. Apologize about that. And they have actually had in the contract be 15 days. Next, give early discount payments. Now, I do want to make sure that sounds great, but again, this is giving a substantial discount. When you look at basically, you're going to get your money 20 days earlier, but you're going to give them a discount, that basically is giving them a substantial interest rate of 40 to 50%. Again, a 1% discount, you're basically giving them an 18% interest rate on the money. In other words, it's costing you 18% to get that money in early. But when you start getting that 4 to 5%, you are going to be giving up a significant amount of your profit if you're a low margin industry. Again, don't be shy to add interest and collect interest on overdue accounts. If it's not within the terms, please have in your contracts or in your agreements that you'll be charging 1.5% interest on any overdue accounts. I love to encourage people to do this because what happens is the first time someone gets it, they're going to call you and say, well, I can't, I don't pay interest on overdue. You can always waive it the first time, but say, you know what, this is something, my terms now. If you're late again, I can't waive it in the future. And again, are you going to lose someone over this? No, but I'm going to also put it this way. Somebody who's chronically overdue is probably not one of your best customers either. Again, reduce inventory by having min and maxes on your inventory. Again, look to see where can you use just-in-time deliveries so that you're speeding up your inventory. A lot of times grocery stores, for example, the way they make money is by having very low stock levels, but they have replenishments 2 to 3 times a month. If you've got a supplier that can get you your goods within a week, you really need to say, do you really need more than 2 weeks of a supply? Again, setting up minimums and maximums so we're just not placing the same order each week. If you're a retail store, buy inventory on consignment. The great thing about that is you basically pay when it's sold, and even then, many of them give you 30 days to pay them when a consignment good is sold. Next, don't hesitate to negotiate price for large orders. And again, get and receive the goods. I'm going to explain this a better way. A lot of times a retail store may buy 2,000 to 3,000 of a specific t-shirt in 5 colors. If you basically say, I'm going to buy 6,000 of them over 6 months and I want you to deliver 1,000 a month, they'll sometimes cut you a substantial discount because of the 6-month commitment, because it's also cheaper for them to be able to sell it that way. And then finally, don't hesitate to negotiate longer terms from your vendors. Again, just like you are basically asking them or your customers to speed up, sometimes if you're in a situation that you're not going to get your money for 45 days, don't hesitate to also say, hey, I'm going to hold off. I want to get 45-day terms. So guys, these are a lot of bullet points in terms of ways to speed up your cash flow. Is there any out there that maybe I didn't mention that you guys have used before? Any way to speed up cash flow that each of you have used? All right, well, let's jump into receivables here. Bottom line, a accounts receivable system. Again, the #1 area that most companies, if they have a cash issue, it is dealing with receivables. First thing, weekly review your AR report. Again, what I'm talking is your accounts receivable summary report. It basically shows what's 30, 60, 90 days delinquent. Again, it's something when, as an owner, you're highlighting things, passing the note to the person responsible, kind of getting that feedback. It truly makes a difference. By the way, I do want to go ahead and double back for a second. John did have a great suggestion here about if you keep in a secure location a credit card authorization on file, again, you can go ahead and have that ability to bill that customer on a monthly or weekly, whatever that trigger point has been set up. So again, John, thank you. That is a great suggestion. Again, one of the best people you have needs to be over accounts receivable. This can't be that person who is the happy person who always wants to be someone's friend. This has got to be someone who's got a little persistency. I cannot stress enough, the squeaky wheel gets the grease in collecting receivables. Number 3, bottom line, develop a strong contract. Again, you hate to say this, but you want to make sure in your agreements or contracts with your customers that interest will be charged on unpaid balance. And then the other one that I find that's critical is collection and attorney fees are the responsibility of the debtor if necessary to collect. The key thing here is if you don't put that in there, you can be paying 40 to 50% of the amount owed to the collection agencies and or the attorneys. By having this simple sentence in your agreements, basically these fees will be over and above the amount that you're being collected. So again, little things can make a big difference. Again, firm, friendly, and fair have letters already drafted. The 38-page thing you'll be getting has a number of different letters and scripts. Again, the next one, if they're a customer who's 60 or 90 days delinquent, don't be afraid to hold up shipments until you do get some of that payment. Again, they are not that AB customer if they're holding off and waiting 90 days to pay you. And then lastly, collection agencies are most successful when they get the accounts within 120 days. If something looks to be going bad, turn it to a collection agency. Believe it or not, collection agencies does not mean that you won't ever do business with them again. However, the collection agency will be much more persistent than your people will to collect this. And then lastly, you've heard me talk A, B, C, D customers. If somebody's poor paying, they're truly a C or D customer. They're not someone who you're going to say is your best customer. A lot of times what I see is either a company, an owner, either firing these clients or charging them a premium because they know they're going to be 60 days before you get the money. Be aware, most of these firms that are late chronically, they know they're not a good credit risk. They're just grateful that you will sell to them. So any questions on the receivable systems or collecting cash? If you're okay, just give me an okay. All right. At this point, I just want to follow up. Cash is king. We're not in here to make profit. We're in here to drive cash for your companies. Again, the profit is not cash, but again, profit should lead to cash. Please take the time to look over both the book and the Excel spreadsheet. A cash flow forecast, once you get in the habit of doing it, it will put you at ease. I recommend most owners once a week glance at it for about 10-15 minutes, at least once a month, maybe spending an hour with their bookkeeper to make sure they're in the same hymnal about why are we in the cash position we are and what does it look like the next 30 days, and as a team, how you're going to fix it. Again, we gave you some quick ideas of improving your cash flow. There's more in the book that you can download. The key here is the 3 big areas of cash flow: inventory, receivables, and payables. You need to leverage those three to make sure you're managing your cash flow well. And then lastly, accounts receivable. We could do a 2-hour session just on how to make sure you collect your receivables. There's a lot of great scripts as well as letters that is in the book that you can download. Again, have that aggressive person who's going to go ahead and be that collector for you. Too often someone in sales or the owner are a little too friendly, and that's not going to get you your money that you need. So at this point, is there any questions that you all have that maybe I didn't answer? If not, I am putting up my email address. If I can help you with any individual questions, I do tell people so much of this varies by industry, and each of you are going to have specific needs and specific differences, but I am going to throw this to you. If you put together a cash flow plan, the amount of time and the amount that it distracts you from doing what you do best, which is providing the service or product, will be minimized. Again, do what you really want to do. This is a necessary part of our jobs, but set up the system so it doesn't distract you from doing what you do best. All right, without any further ado, Laura Lee, do I throw this back to you or Alicia?
Sure. Does anyone else have any questions? Okay, I guess not. Thank you everyone for calling in and joining this webinar. I'm gonna post everything on iConnect, so it should be up later this week. And all the materials that Steve was referring to will be up as well. Thank you, Steve, for this awesome webinar, and please be in touch if you have any questions.